The Fed meeting begins today, and the central bank's interest rate decision will have a big impact on our next guest industry. Joining us right now to talk about rates, banking, and commercial real estate is Scott Rechler. He's the chairman and CEO of RXR. And Scott, obviously, a lot of industries watching this, maybe none more intently than the commercial real estate industry.
No, there's no doubt. And we've been waiting for this for quite some time. But I think, this debate between 25 and 50 basis points is not that relevant, because I think the FOMC, which is sort of the Federal Open Mouth Committee, has done its job using its narrative to effectively loosen financial markets. I mean, you've seen the 10-year come from 5% down to 3.6%. The S&P all-time highs. The bond markets are wide open. So from the standpoint of the looser financial markets, we've already seen that starting to flow through. And so I think that whether it's 25 or 50, the Fed's in a position where they'll take a more measured approach, is my guess, in terms of not doing anything that surprises the market and try to find the right glide path down to wherever the right new normal is.
What have those loosened financial standards meant for commercial real estate to this point with what we've already seen happen?
Yeah, well, a couple of things. One, if you remember, we've talked in the past that we expected, this $1.5 trillion of debt to start coming to the market. And when you look at that $1.5 trillion of debt...
Is that by the end of next year?
That's the end of 2025, yeah. Right? And so if they estimate that values are down 25 to 50%, so to actually refinance that, it could be somewhere up to 50% needing some level of equity infusion or some level of debt restructuring. By loosening the financial markets, as that starts maturing, right, and they push some of that off, it has now positioned banks to take more reserves. It's taken the private sector to actually allocate capital and to be in a position to participate in that re-equitization. So I think it will make it more of a standard, more programmatic type approach to this versus some chaotic level of crisis.
This does not feel like a crisis to me at this point. There are going to be people who take a big haircut, who lose their shirts on deals they did that they shouldn't have done. But it seems like there's private money there that will step in at the right price and shore those things up. This doesn't feel like a crisis on a state or a national level.
Right, and I agree. And I think if again, there's a continued ability to keep the markets loose in terms of financial markets and access to capital, the capitals will come. And I think, as a private investor, this is sort of a generational opportunity to invest because the banks are on the sideline. So you have this gap where you need equity infusions into properties that are good properties with broken capital structures in an economy that is relatively stable, that you can then come in and re-equitize that. And that's, I think, where you're seeing money starting to flow and be prepared to take advantage of that opportunity.
That's something you're doing in a partnership that you've put together, too, I think, with Ares. How much money do you all have to deploy? Where do you see the best opportunities?
Yeah, so, I mean, for us, with Ares, we have an office recovery vehicle, which is, I would say, a little bit more contrarian, and that's probably the one segment and sector of the real estate market where you haven't seen capital flow back to right now. People are
just because people aren't back at work in large forces.
Well, in New York they are, right? And you saw Amazon yesterday.
We're not back to where we were in 2019.
This year probably we'll have leasing volumes in Midtown Manhattan back to probably 2018 levels, right?
Really?
So people are coming back to the office. You saw Amazon's announcements yesterday.
Yeah.
But it's still people view the sector as going through a big structural change. Multifamily and housing is where I think the bigger opportunities.
Let me ask a little bit more just on commercial real estate. If you expect that Midtown Manhattan will see the leasing levels that we saw, let's say 2018, what about pricing on those leases? Is it at the same levels as well?
Yeah, I mean, the face number is the same level. The amount of concessions, so the net effective rent is still down, right? And I think that's where you need to see the inflection point of enough demand where there's not enough supply, you can have some pricing power. And it's really asset by asset, right? There's still that flight to quality. 80% of the vacancy in New York is in 30% of the buildings. So there's going to be a lot of buildings that are going to be competitively obsolete as you go forward. So it's like a stock picker's play. You got to really be focused on the property itself and its competitiveness.
What type of concessions are you talking? Free toilet paper, or you don't have to pay 2 months rent?
Free toilet paper would be good. Free toilet paper would be good.
Or you don't have to pay 2 months rent after
It could be 12 to 18 months rent. The biggest thing is tenanting costs to rebuild space could be $150 a square foot, where it used to be $50, $70 a square foot. But there is, in the higher quality buildings, particularly in Midtown, there's a scarcity of large blocks of space. So what we're seeing is, as those spaces come due, tenants, are grabbing those spaces. And we've invested close to $1.5 billion in equity into office buildings in New York, and then have negotiated new deals with banks, reduced basis. Our bigger challenge has been we've getting the space leased before we actually get the restructurings done, right? So that's a part of the challenge.
Yeah.
But I think more broadly, the housing sector and playing in what I'll call credit solutions, part lender, part partner, to help re-equitize that segment is really where the big opportunity is going to be over the next 2 years.
It's a little bit of a contrarian play, though. It's interesting that you guys are really doubling down on this.
Right. Well, and what's interesting is when you think about this play, first, I would say it only right now works in New York. The other cities have not seen people come back to the office like New York. And second, you really need to understand the nuances of each building, each submarket, and be able to have not only the capital, but the capabilities to reposition those buildings.